Weaker than expected jobs report this morning alongside a lot of tariff headlines, and Chair Powell of the Fed and President Trump set to speak later today. Here to help us break it all down at Post 9 is Jan Hatzius, Goldman Sachs chief economist. Maybe we'll just start with what we heard from Peter Navarro. Market potentially reacting here. The Dow's down 200 points as we speak, talking about reciprocal tariffs. They're coming. I mean, this is the way they want to fight what they think is unfair trade terms by matching other countries on high tariff rates. What's the economic impact?
It really depends on whether it's the tariff differentials or tariff differentials plus other things like sales tax and VAT differentials. If it's just the tariff differentials, the impact isn't going to be that large. We estimate only about 1 to 2 percentage points in terms of the average U.S. tariff rate. But of course, many foreign countries, Europe in particular, have much higher sales tax rates and VATs. If you view that as a tariff equivalent, then you're going to get a much bigger impact.
Now, well, they do. Don't they? They do.
Well, yes. So if it's really one for one, if they haven't been totally clear about the formula, if it's really one for one, and you take 1 percentage point of VAT as 1 percentage point tariff equivalent, then we're talking a much bigger increase, more like 10 percentage points or so. I think in the end, we'll see. Of course, there are announcements, there are threats, and then there's the ultimate number at which they land, which may be somewhere more in the middle.
Do you buy their economic argument that all of this is going to lead to more investment, manufacturing, and jobs in places like Akron, which I know very well, because of what they're doing on trade? Do you buy that? Is it going to work?
I mean, over the longer term, I think it can certainly have some effects. I tend to focus on the more near-term impact, and the more near-term impact is that if you increase tariffs, there is going to be some impact on prices. The PCE price level, by our estimates, rises by about 10 basis points for each 1 percentage point in the average tariff rate. And then there are some growth effects as well. So in the near term, it's going to have lower growth, higher inflation impact.
What type of growth hit are we talking about, or is it just too uncertain to tell from this point?
Again, it depends on how much you end up doing. If, for example, you had a 10 percentage point increase in the average tariff rate across all U.S. trading partners, I mean, our estimate is that's about 100 basis points on core PCE on the price side. And then on growth, somewhere between half a point and 1 point. That really does depend a lot on maybe more psychological factors like the uncertainty that's being created, how much of an impact that has on business investment, in addition to the sort of fiscal tightening effect of this. There's also the question of what happens with the tariff revenue. You get additional revenue, that's, of course, a fiscal tightening, negative near-term growth effect. But then if you recycle that additional revenue into tax cuts, then you blunt that impact. So I'd say on prices, we have estimates that are probably more reliable than on the growth side, but it's not going to help growth.
That you haven't made any changes really to your at least your Q1 tracker, right?
Q1 tracker is 1.6%.
Right. You've been pretty steady.
We took it down after last week's data, or the week before rather, but not by as much as some of the other trackers like the Atlanta Fed's GDP Now, which we think shows an exaggerated amount of weakness because a lot of the big increase in imports was gold, which isn't going to show up in the GDP numbers.
Right. Is the jobs number reflecting any of this government efficiency push yet?
Well, there was a 10,000 decline in federal employment, so with the exception of that, which is a relatively small contributor, I don't think so. And I think more broadly, the jobs report was, a touch weaker across a range of different components. But overall, I don't think there was really much that we learned here.
Is household too volatile to really watch?
I think so, yeah. I think the household survey is too volatile. I mean, the household survey was a bit weaker. The unemployment rate was a bit higher. U6 rose. So I'm not saying it was a strong survey, but I certainly wouldn't take the month-to-month change in household employment as a reliable indicator. And then on the payroll side, again, a touch weaker, but not dramatically.
Right. We mentioned work week earlier. Explain to viewers how that mental calculus works. If you are trimming work hours. Is that a precursor to cutting, or is it a cushion to where you might eventually be able to add hours back?
Well, it could be either of those two things. I think statistically, if you just look over many cycles, you would say the work week often moves a little bit ahead of the actual employment numbers, so it can be a bit more of a leading indicator. Again, the moves that we've been seeing are not large enough for me to say that this is the precursor to anything. There are some real risks to the economy, which we've been discussing. They're mostly policy related. I don't think there's much in the current labor market picture that would make me worried. There was maybe a hint of worry in the jobless claims numbers a week ago, but it came back down, and it turned out to be, if it wasn't an alarm at all, at least a false alarm.
You getting questions from clients about stagflation?
I mean, sometimes.
Is the risk rising?
I don't know how stagflation is defined exactly, but if you have
stickier, higher inflation,
well, if you directionally, if you have higher inflation and lower growth, then it's a stagflationary direction. But I wouldn't call it stagflation. The economy is still growing at close to 2%, and inflation, while above 2%, is not that far above 2%. Now, could you tell a story where things continue in that direction? You could, but I wouldn't at this point.
One more question, which is, we are seeing signs of weakness pop up, in certain economic spots. We see it in the bond market being reflected. And I think it's presumed that tariffs are the main risk right now, right? And we're moving around on those headlines. But what about monetary policy? I mean, could some of the underlying weakness that's showing up now have to do with the fact that we are still at high interest rates and they are restricting the economy? I mean, housing's been a particular mess lately.
I think, look, the funds rate is still above most people's estimates of neutral. So all else equal, of course, if you were 75 basis points or 100 basis points lower, that would provide a boost. One thing I would say, though, until the recent weakness in the equity market, if anything, financial conditions were significantly easier than a neutral reading, and I tend to look more at the level of financial conditions. That's obviously changed to some degree. We've seen some tightening in financial conditions, but we're definitely not in an environment where financial conditions overall are tight at this point. So I don't think that there's a strong signal from what you're seeing in the interest rate environment and in the financial conditions environment that the Fed, needs to bring the funds rate down soon. So I don't expect them to do anything very soon.
Okay, Jan, thank you very much for joining us.
All right, thank you.
On a more lively jobs day.